Good afternoon, everyone, and welcome to our Friday update here on DataDash. My name is Russ, guys, and if you remember during our conversation with Nick on Wednesday, we mentioned that this particular week gonna be very important in the macro world. So today, I'd like to take a few more minutes to actually cover that. And the reason I'd like to do that, to help you guys building the long-term conviction. It's very important to understand what kind of market and what kind of environment we are in. And I am not getting tired to repeat that because being in the ranging environment where you need to stay extremely vigilant, quickly get in, quickly get out, never keep the liquidity overnight is very different to when we are in the trading market. And the reason I'd like today to mention a few other asset classes is because for me, from my perspective, we are actually just about to move from the ranging into the trending environment. And that can give us the tremendous, amazing entry opportunities where we can actually build a stack and then later on use it as a collateral for all the future short and swing scalps and so on and so forth. So, with all that said, let's dive into the Fed meeting this week. The Fed balance sheet had been dropping at a $70 million per month clip and now on a pace of $56 million per month reduction clip. So they are reducing balance sheet, but the speed with which they are reducing is going slower. By this, I mean quantitative tightening is normally hawkish. But if we actually zoom out here and we'll see the perspective for the last year, we were able to see that here we might actually start a slow growth again. So decline is not actually having any sustainable pace in the longer run. Meaning that even if the quantitative tightening could not get the markets down, reducing quantitative tightening should actually help markets even more to move up. And it's, to me, as I said, is very bullish. And I've been bullish already on Wednesday and my stance stays the same. So after high inflation prints, this is not the time to announce the taper or quantitative tightening. Just a side remark here, because you might have heard the word taper as a bad thing for the markets. That was in the context of the taper tantrum by the stocks years ago when they were slowing the quantitative easing or the extra liquidity they were bringing to the market. They were reducing the dovish stance. This time taper is actually reducing the hawkish stance, and that's why it is bullish. Also, guys, interesting to notice that the jobless claims continue to be strong. I mean, they continue to signify the strong economy. It needs still to be watched on the weekly basis, but the fact that they are not breaking out to new highs, it is actually very bullish, and it actually provides an opportunity for the Goldilocks scenario where we might even have the opportunity of soft landing. We never had that in the past, but with the modern monetary theory, when the government doesn't care so much for deficits and can further on debase the currency to kind of patch the problems in economy, this is not out of question. So to sum up, number one and number two yet to be watched. I stay bullish for the next at least 3 months, potentially for the 6 months. So even though I've been speaking about the cuts recently, by now I really don't care if they actually cut or not, like who cares? If Fed is slowing down their quantitative tightening, which means they're buying more bonds, lowering yields, expanding DCF stock valuations, juicing inflation, all the prices including stock prices, Bitcoin prices, oil prices, and yada. So I really care less if cuts are happening. Are we gonna have 4 cuts, 3 cuts, 2 cuts this year? It's not so important. And the way Jerome Powell was talking on the press conference, that's clear that he is worried about something in the system to break. whether it's banks or whether he received a friendly call from Mr. Biden saying that he really needs markets to be up until November, this we don't know. And of course, having the scenario of inverted yield curves for longer, it is quite dangerous for economy in the long run. So that's probably also the reason why Fed would be starting this year already to cut the interest rate. But as I said, what's more important for me is how asset classes are gonna act here. And let's take, for example, Bitcoin. Bitcoin, I think, would totally benefit in the midterm, in the long term. Of course, short term, there can be some liquidity grabs, there can be open interest wipeouts. We will see the liquidation zones in a second. But guys, in the long run, that's why I spent several minutes to really speak about those. You have to build your conviction, and I've been quite bullish since more than a year by now, and I think there is a reason behind, because there are multiple central banks and they all are acting pretty much in an alignment. I don't see by now that the country is achieving a certain form of self-discipline or austerity. So if Federal Reserve is actually getting dovish on high inflation prints, it is the sign that someone inside is going to be purposefully asleep on this inflation rise. And because someone needs to buy all that governmental debt with no fiscal discipline in the US or most of other countries. So the only way out of that is slow spending, which is not going to happen, or to print more currency for the government itself to buy its own debt. The more currency that prints, the less it's worth, and so the less it can buy, or inversely, the more things cost to buy. This is inflation. In my opinion, gold will do well, silver will do well, Bitcoin would do extremely well. And I don't see actually countries achieving any form of self-discipline or austerity. So the Fed getting dovish in a very high inflation print, in my opinion, is the sign that someone inside is kind of purposefully asleep on that. Right? And there is no fiscal discipline in the US, there is no fiscal discipline in other countries. So the only way out of that is either slower spending, which is not going to happen, or to print more currency for the government itself to buy its own debt. So the more currency that prints, the less it's worth, and so less it can buy, or inversely, the more things gonna cost. And this is inflation. And don't forget that inflation just does not affect only the goods. In a certain long-term environment, it also affects the stocks because it affects the EBITDA and price. So guys, let's have a look on the Bitcoin chart. What do we see here? I would outline 3 scenarios. Actually, for the upcoming week, I think that's enough. Bitcoin is moving quite slow here. So the scenario A would be that the low time frame support holds and we test 69.2. I drew this line a few hours ago, but it doesn't seem like we're able to hold it and come back to that level. Scenario B for me would be actually to print the higher low here, swipe that week, and retest again our 62.9. That will be the second thing I would be looking for in the upcoming 4 days. Let's mark it as B. And the third scenario, I think it is also quite probable. I would like to bring here the 57 level. I'll show in a second why. Let's mark it in a different color. For example, in blue. So here I would like to look for the reaction towards that level and see if we can hold it and then bounce back. Current market is actually quite choppy. I would not rush to trade here, neither I would rush to allocate. Just to be absolutely transparent, I would love to be further on. I show the trades, the sizes, entry points, stop losses, pretty much everything when I make the move. It's not an advice, but you can simply follow. Basically, I'm 0% exposed right now into crypto. I'm quite exposed into the stocks, and I'd love to cover those in a couple more minutes. What I would be looking for here is to allocate 20-30% at 57 level and see for the reaction there. So on all the time frames, if we're gonna look at liquidation levels on monthly, 3 monthly, 6 months, 7 days, and 12 hours, what stands out is those huge liquidation zones in the area between 55 to 60,000. That's the reason why a minute ago I said that I would love to look at 57 as the DCA value, the dollar cost average value for my entry. I would like to stack them, let's say in between 50 to 59. Obviously, taking into account the amount of open interest in the market, there will be a number of liquidations, so there's no need to rush for me. And as I like to play some stinky bits in this case, I would expect that after those levels are tested, the level around 70,000, you can see on the screen here too, which is on the lower term time frames on the 7 daily, should be retested as well, because the shorts are, in this case, will be feeling maybe too much relaxed and too much complacent. So at certain point they would also be taken, but those we would see later. For now, I don't expect a huge volatility actually around Bitcoin, so I would not be focusing so much on this market. There are two better setups in my opinion in the altcoin space. Let's have a look. First and foremost chart that really strikes out for me is Aave. I mean, fundamentally strong coin and having a very, very, very clear retest on daily. So I would not be afraid to position here with a very, very tight invalidation, 2-3% max, simply expecting the bounce to take place. Why I also would say it's relatively safe, because on the BTC pair, as you can see, we are forming that's like bottoming formation. In my opinion, that's a good opportunity to scale in some quality projects if you miss the entire move. On the other hand side, I would really be welcoming the scenario where actually Ethereum runs 3520 and then we have acceleration across the board. But for those to take place, we first need to accept into the previous range. We would need first to break over those local high, break the structure. Until these take place, please guys, no rushing, no raping, because those lows are not safe, definitely not safe. Those lows. And so I would for sure not rush into Ethereum here. And absolutely the same for Bitcoin here. Just wanted to be explicitly clear. Until we accept here into that zone, there is no need to long anything. We can actually stay over a week or two and chop between 60 and 70. That's gonna be like a scalper's paradise, but the majority of people would actually lose money in this environment. So yeah, maybe just wait for 69.2, 69.5 to be reclaimed, or as I previously said, 57 can be a good zone to beat and look for the reaction there with the tight invalidation around 55. So let's now have a look on those asymmetrical bets across the stock market. And of course, the first thing that comes to my mind is the cannabis market. When Kamala Harris came out on the state media last week, and she said it's very, very absurd and unfair that the weed is actually being treated the same as heroin and other Schedule I drugs, and even way more seriously than fentanyl under federal law, especially taking into account how many people have died in the US from fentanyl and so on and so forth. It actually gives us a very clear direction for that market. And one of my favorite plays here is actually Tilray, a Canadian brand. Without going too much into fundamentals, because we will not be able to cover everything on that stream, Just for you to understand, there is a company which is around $4.3 billion in assets, but the market cap is just 1.5. And of course, that comes from, on one hand side, not that high revenues, on another hand side, the fact that the company is still not net income positive. Obviously, with this high interest rate, there is a concern of investors that in the long run it can go bankrupt if it doesn't actually break even in the nearest future. But taking into account all the acquisitions they have done last year, taking into account that it's one of the biggest companies in the world, if not the biggest in the cannabis sector, it is quite hard to fail at that size. And I would say from the fundamental perspective, I'm quite safe that we are not getting towards the bankruptcy. The reason for those is the dark pool data. I start seeing that more and more institutions are owning the stock. The institutional ownership is above 50% right now. It actually means that the large players who cannot afford to buy the company from the open market just due to their bid sizes being like 30, 50, 80 million dollars, they would affect the market or would just simply not get filled. But they are allocating more and more into Tilray. So what I like here about Tilray in particular, let's just have a look on the structure. Well, we printed that higher high. That already gave me an idea that we are breaking out of the previous downward formation. Well, I'd like to go first on the weekly so you see how heavily the stock is actually depreciated. You know, just like in a matter of couple of years, we dumped from, let's say, 30 to less than $2. And right now we are consolidating. Like I don't really like trading meme lines, but you see how clear is this meme line here, whatever you take. A lot of people that are trading that stock would actually follow it. So I would not completely take it as irrelevant. At the time of this recording, the stock is actually performing quite well. I see that this breakout takes place. And I would really like to have those tight invalidations. You know, when I enter something at the, so to say, generational entries, of course, making a joke here, the stock can still dump below those lows. But for me, the risk reward here is quite good. You know, guys, you can maybe place your stop loss at around 150, and then if you're actually kicked out, which is quite probable because it might happen that you know, market maker goes for this like last liquidity grab towards here, and that might signify that we have a swing failure pattern, so-called SFP, where we kick out all the passengers before the train actually takes off. And when we are speaking about the targets, I would not be shy away from having 2-digit dollar targets. And the reason for those, first, as I mentioned, institutional ownership. Also, just simple mean reversion. That's also how a lot of institutions are trading. So when it comes to potential price targets, I would not be shy away to expect the stock to go to late 8-9s or with a certain retrace back to, let's say, 556, potentially all the way to 20. Because what happens normally in those kind of very, very, very immense deviations from the moving averages, on one hand side, the stock becomes very much squeezed, and then we have a potential for short squeeze or even for a gamma squeeze, and that can happen with an increased institutional ownership that actually takes place through the dark pools. So later on, when the retail investors are realizing that the stock is actually due for up, they start selling, for example, cash secured puts on that stock, and the market maker on the other side of the trade needs to go delta neutral, so he needs to hedge his position. They actually starts buying the underlying stock, and that
acceleration takes sometimes unprecedented places. So stock can rally very, very quickly, especially on the potential news, and especially taking into account how quickly institutional ownership is increasing. Me, myself, I started building a position. I'm actually quite transparent always about my position. So you can see my position sizes, my average entries. Tilray, my average entry is around 190. Cannabis around 360. That is slightly less risky play. And Sundial Growers in the middle, mid-sized position for me. I entered roughly at around 150, and there I would expect a way higher beta to Tilray moves, because normally the smaller players are slightly more volatile. Please, guys, let me know in a comment down below if you'd like me further on to elaborate more on my trades, or maybe keep up the Twitter where I would actually post my positions not only when I enter and when I accumulate, but also when I take profit. Let me know if it's of a value for you, because it's additional work, but if a lot of our viewers are happy about it and would like to, copy trade me, firstly in this like kind of manual format, I'm happy to do that too. So please let us know. If for certain reason you believe that cannabis as an asset class is too volatile or too risky for you, that's totally fine. I can understand that. That's why I invite everyone to look into actually Magnificent Seven. And in my opinion, Apple is one of the companies that still did not get their AI move priced in. We know that everyone else, including Nvidia and Meta, and even to a certain degree Google, that has been very, very much plummeted on this wokeness kind of rumors around their solution, have already significantly moved. Apple is still lagging, and Apple has been purchasing and acquiring various AI startups, spending around 80 billion recently in the last year, and we are clearly not fully yet aware about their pipeline. So I recommend looking at a stock here. It is traded in a lower 170s. And one important thing that I would like to share, we're gonna have a separate video around it, because in my opinion, this is very, very, very important. You are not obliged to go and buy at 72 at the market. You see on the right hand side an option chain. On the right side of this option chain, there are put options. So what you can do, you can actually sell the cash secured put. But if Apple is actually falling down below $175, then you're buying it, you're forced to buy it from the market for 175 minus the premium that you inevitably collecting. So it actually makes it less than $170 cost of ownership, which is kind of below where we are right now. So it is a good deal for a blue chip stock, We're gonna talk more about how the option assignments and option wheel works, but as a rule of thumb, if you are not owning a certain asset, there is always the way to get into it slightly cheaper. And we will discuss those in details later. And another thing that is very interesting for me to actually look at here is Russell 2000, IWM as a ticker, the ticker that actually combines mid-cap companies, normally due to the fact that small and medium-sized enterprises, they're having lower profitability and very often not as efficient cost of capital. The high interest rate environment is affecting them more negatively comparing to, for example, S&P 500 and Nasdaq, which are already in their all-time high territory, right? So it's way more beneficial, in my opinion, to own Russell 2000 here, expecting the mean reversion. And I pointed out a couple of zones where I expect this move to take place, either to $128 or to $112, or all the way towards the previous all-time high, which is gonna be almost 20% move from here to roughly $243. This is like something where you can bet at safely, in my opinion. You don't have to worry for a particular company, for a particular risk associated with the poor management, with the credit unavailability, bad decision making, poor acquisition pipelines, and so on and so forth. You're basically betting on American mid-cap market to recover to its previous values following S&P 500 and NASDAQ. So I would consider it as a safe bet. And once again, I would use that bet as a collateral and probably allocate a significant amount. I'm actually quite allocated already to Russell 2000. I would like to increase my exposure if we actually drop and retest those levels of the previous highs around $202, $201. So I would extend my exposure because my invalidation will be lower. And then I would like to use that Russell 2000 as a collateral for future short-term trades. And last but not least, because I remember on Wednesday few people were asking, having those questions, so I quickly elaborate and then we're gonna have a separate time for that discussion. But as you remember, guys, I'm quite bullish on silver. We've discussed today Bitcoin and gold. Silver is something that is on top of that very much used industrially. As I mentioned, every electric vehicle, every solar panel, every smartphone, every semiconductor, if you're betting on the technological growth, independently which scenario you're taking, I guess this is like an incredible opportunity to actually get exposed to that growth without too much of a risk. Why I'm not so interested in gold? Because as Nick have been mentioning last time, and myself too, we both like to chart relative charts, and gold to silver ratio provides this very clear negative market structure, downward looking market structure, where we actually had the breaks of the lows and then the retest of the order block and then another lower low is printed. Why I'm looking at this ratio actually quite a lot for a couple of years already, because my projection for gold to silver ratio is all the way down to, as I mentioned, 40. And I am, guys, not someone who's gonna go and trade paper silver, even though I would expect that 23 or 24 would be very much of a bottom formation for that metal. I would be very, very much likely to get exposed to the companies which are producing silver and which are the one behind assuring that there is a supply of that metal. Those are, I remember been asked in the comments which are my favorite bets. I have multiple, because this is the market I've been analyzing since 2020 for almost 4 years. Very close to following all the daily updates and having quite a big exposure. We can go through my portfolio later on, but for now, since we don't have that much time, if someone wants to enter, I recommend the simplest way to enter through the Silver Junior Minor ETF. It actually, don't get scared of the word junior. It only includes existing producers and mid-cap companies, mainly Pan American Silver, First Majestic. If someone knows, please let me know in a comment. I'm very, very happily to elaborate more on the topic. But as we discussed with you last time, charting silver miners versus silver gives us a very, very good understanding that we are close to the bottoming formation here, and we have this breaks of the highs, and now we are creating this diagonal bottom formation. So I would expect from here, especially with everything that we discussed today in macro, including declining interest rate, including more affordable cost of capital, for those companies to actually outperform significantly silver. And this is the reason why you still can catch that wave, catch that growth that happened, for example, across the Bitcoin miners when Bitcoin did 170%. CleanSpark, for example, did roughly 600%. Marathon Digital Holdings did around 350%, and so on and so forth. As I mentioned, guys, in my opinion, the next 7 days are not going to be the most exciting in the crypto market. And exactly for that reason, I gave you a few asymmetrical bets across other asset classes. But it's super important for me to know your opinion, actually, what's of the most value to you. So please, I invite everyone to put down in the comment section, especially since I'm just starting to share my knowledge. What are the asset classes that are most important for you? Or if you would actually like me to stick to crypto, even though it's not very volatile in a particular week, we can still find a way to make a couple thousand here and there on an intraday moves, scalping on a 15 minutes time frame. That's something I've done a lot as well, and I'm very happy to share. With that said, guys, I wish everyone the great end of the week. Please don't forget it's a weekend and markets are 24/7, so please don't forget to go touch the grass. If it's that said, big hug and see you soon.